I believe you can see my screen.
Yes. Yes, class.
Okay. Good. So the first thing first is how to deal with retained earnings, right? How to deal with retained earnings. Now, why retained earnings? Let me explain. In the basis, like the basis of accounting, when it comes to investors, all right, it's simple. So the investor invests an initial investment. Are you following? Are you following?
Yes,
The
sir.
Yes,
investor
sir.
invests
Yes,
an
sir.
initial, he puts an investment into your company. Good. So if I have put an initial investment into your company, you are supposed to give me a return because there's a risk return trade-off, right? Or if I put in some money into your company, then I need a return on that investment. So definitely, if you take your initial investment, you have to add any return. Are you getting it? It's like principal plus what? Plus what?
Interest.
Plus
Interest.
you get the idea. It's like principal plus what? Interest. Now, assuming the bank deducts charges, won't the charges also affect this? Won't it also affect this? Won't it
Yes,
affect
it
what
will.
the investor is going to get? Yes, it will. So the same way, we are saying that there are two investors in a consolidation scenario. The main company, let's say there's a bakery, right? This is the bakery. And then you and your wife decide to invest in the bakery. So this is you. You contributed 90% of the whole thing, and your wife contributed 10%, right? So we are saying that if we are looking at it in investment terms, you are the controlling interest. True or false?
True.
True or
Very true.
false? And your wife becomes what? The non-controlling interest. True or false?
True.
Because your wife only has a small percentage. Now, the controlling interest controls everything, irrespective of that 90%, because literally you have control. We said you have control when you can govern. So when you own more than 50%, there are situations where you can have less than that. But this is the most important concept, right? So your wife is the NCI and you are the parent or the controlling interest. I prefer controlling interest so that you get it. Majority interest and minority interest. That's what NCI. So NCI and the parent are all investors, right? But because we are preparing accounts for the owners of the parent, that's why we still disclose NCI, because I control everything in the business. Now look at this. This bakery, some people's background is noisy. So this bakery to this guy, okay, to this guy, that is you, it becomes what we call a subsidiary. Okay. This is your investment, but this investment is called what? A subsidiary company. Why? Because you have control over it. But to the NCI, it's not a subsidiary, it's an investment. Does it make sense? It only becomes your subsidiary when you own more than 50% of it. But to this, your wife, it is not a subsidiary, it is rather what? It is rather what?
An investment.
Investment.
An
Investment.
investment. Do you understand? But if it is more than 20%, then it becomes an associate to this guy, but it's just 10%. All right. So look at something here. Now, why would I invest in a bakery? Is it not because of the profits? Is it not because of the profits?
Yes, sir.
Good. But then this bakery would have had some reputation and some other stuff, right? So if we pay extra, that extra we pay is what we call goodwill. Do you remember?
Yes, sir.
I said this the last time. Yes. So it's two things. One, the goodwill, and two, the profits. That's the main reason why you are preparing consolidation. Apart from that, there's nothing else. There's no reason why you are preparing consolidation. It's these two things. But these two things have some other workings that you need to work to get. That's basically it. So we are saying, that, okay, now this bakery, assuming this bakery had net assets, okay, of 400,000, okay, that is assets and liabilities, right? But because net assets are the same as equity, that's why we usually pick the equity side. Now, if it has net asset of 400,000, you are literally supposed to pay 90% of 400,000, true or false? And your wife will pay 10% of 400,000. Is that not so?
Yeah.
Yes, sir.
Okay. But here lies the case. You went on to pay, let's say, 390,000, and your wife paid 50,000. So what has happened? Did you pay extra?
Yes, sir.
Yes.
Yes,
So it means that instead of paying your 36,000, 360,000, you paid 390. So you paid extra. Your wife also, instead of paying what? 40,000, she paid 50,000. So that means you have paid for what? Goodwill. Do you understand? Now, this
Yes, sir.
was this guy's net asset at the date you bought the bakery. Now, at the year end, the net asset of this bakery has now become 500,000. What has happened?
That's an increase.
There's an increase. So anytime this bakery increases, don't you have a share in that increase?
Yes.
Share no other forms is here the venza. Don't you have a share in the venza?
You
Sure.
do.
Of course, of course. So this guy has gone to see this girl. When he met the girl was living in a single room. Now the girl is living in a mansion. He deserves the applause. He needs a share. That is it. It's the same idea. Now, let's see why it gets interesting, right? So now, the whole secret comes when you are dealing with a subsidiary in the same year or in like a mid-year acquisition. That means it wasn't a full year acquisition. Let me explain. So, anytime you have retained earnings, it's not given, right? I'm going to show you several ways. So, anytime retained earnings is not given. All right. Those doing corporate reporting, yours will be later. All right. This one applies to both of you. But corporate reporting, retained earnings can be very cumbersome, especially when there's a disposal. All right. You guys doing FR don't do disposal, so I can't go there. But it's the same principle though. So anytime retained earnings is not given, you know, usually consolidations that the subsidiary is a full year subsidiary, the retained earnings is given, right? But where retained earnings is not given, it's that simple. Always take the retained earnings when retained earnings at acquisition is not given. That's what we mean it's not given. The closing retained earnings is always given. So when retained earnings at acquisition is not given, you are going to take the retained earnings on the balance sheet, the one at the reporting date, right? So you are going to take the retained earnings at the reporting date, and then you are going to subtract your contribution period, right? So if let's say you want to know what was there before you came, okay? You want to know what was there before you came and what? Move the girl to a mansion. What did she have before you moved her to the mansion? Do you understand? So you are saying that, okay, if let's say you acquired this subsidiary in 9 months, like it's a 9-month acquisition, then deduct your 9 months, are you getting it? Out
Yes.
of the 9 months profit is your contribution. Take it out. Do you understand? Take your 9
Yes.
months out to see what was there before your 9 months came. Do you get the whole trick? So when retained earnings is not given, this is a trick. Did it make sense?
Yes, sir.
So if I give you a dummy financial statement, right? Parent, subsidiary, and then I say, okay, this is let's say this is the net asset of the subsidiary. The parent 400,000, subsidiary, let's say 300,000, right? Then I have equity. So let's say I have share capital, right? Share capital 10,000, 20,000, right? Then I have retained earnings. Retained earnings, how is this thing behaving like that? So retained earnings, this one is going to be 390,000 for this guy. And that is going to be 280,000, right? To balance of 390,000 and then what? 280,000. Okay, so let's say this is the information we have, right? And then P acquired what? Let's make it 1 CD. P acquired 80% of S on, let's see, 1st April 2024, right? Okay, they didn't give, but in the P&L, let's say in the P&L, they said maybe profit after tax for the period, let's say P and S, right? Profit after tax for the period, assuming everything accrued evenly. The profit after tax for this guy was actually 80,000, right? So this is what you have. This is what you have. So if I tell you that, okay, find retained earnings at acquisition, we are preparing the account at 31st December 2024, right? So if we are preparing accounts at 31st December 2024, if you are actually looking at it clearly, how much retained earnings, this is what it means. So from 1st January 2024, were you there?
No.
Were you there? But you know this profit is from 1st January to what? 31st December. True or false? So as
Yes.
at 1st January 2024, the girl was doing her own thing. You didn't know her. Now, fast forward to what? 1st April. That is where you came. True or false?
Yes.
Now, if we go then to December, that's 31st December. Were you there? You are with her, right?
Yeah.
So we are saying that, okay, this whole profit of the 80,000 that this subsidiary has made is the profit for the whole year, which you were not, like, you are part of it, but maybe your ex-boyfriend was also part of it. You don't know. They understand. So if you want to get what was there before that April you came, what do you have to do? Find your portion of the profit and just deduct from the total. True or false?
Yes, sir.
That's all. So we are saying that, okay, if the whole thing, how many months acquisition is that? April to December, 9 months, right? So in that
Yes.
case, we know the whole thing is 80,000. So here is 9 months out of what? This 80,000, right? And the other
Sure.
side is what? 3 months out of what? The 80,000. You can decide to use the 3 months, right? And add to the opening retained earnings, but it's stressful. Just subtract this from the total retained earnings, and then you are good to go. Let's see how that works. So we are saying that out of this profits, if you split it, what do you have? 3 months of the 80,000 is actually what? And 9 months is what? Quickly. You must have calculators. You must be very sharp.
3 months is 20.
20,000. Okay, so the 9 months is what?
60.
60,000, right? Okay, good. So if I'm preparing my retained earnings account, that's the net assets I have at acquisition for the subsidiary and at the reporting date for the subsidiary, right? Good. So this is what we are saying. If I decide to take my net asset by taking my stated capital, so my stated capital will still be what? 20,000. The assumption is that no new shares were issued from the acquisition date. It's even the same year. Please, some people's background and the fidgeting, the fan, and those things, they are disturbing. So stated capital, then retained earnings. Now look at something. The retained earnings, please, anytime you see this acquisition, the reporting date is the same as the balance sheet. Okay? I said the reporting date is the same as what?
Balance sheet.
The same as the statement of financial position. So any adjustment you do to the reporting date appears on the balance sheet. It's the same as an extract of the balance sheet. That's what you must know. So if I add 1 here, I must add 1 on the balance sheet. If I deduct 10 here, I must deduct 10 on the balance sheet, because this is the same as your net assets. Does it make sense? Is it clear?
Sure. Sure.
Now you are saying that at the report schedule, at the reporting date, your total profit is what? 280,000. Good. But you want to know what was here before you came, or what was here the day you acquired her, the day you met her and said, Madam, I like you. What was already there? That's what you are looking for. And this is what you can tell. Okay, that your contribution came in the form of only 60,000, right? So out of this 280, what the account here then? Only 60,000. So what was here before you came? Is it not 220,000?
Sure.
This is all about when retained earnings is not given. This is the trick. So all you have to do is just say, okay, so the total retained earnings was 280,000, and I contributed 9 months out of the profit for the year of 80,000. So that means if I take 280 minus my 60, I get the 220 at acquisition. That's all.
Sir,
Yes, please.
from the period, say the 6 months that you did with her,
Not 6
which is
months, 9 months.
the 9 months you did with her.
Yes.
Sir, the profit over there to them for the 9 months, sir, it is not, she has a portion of that profit too. I don't know whether you understand. So we are always saying that what we
Let me explain. Let me explain. Let me explain something. We are looking at profits before acquisition and after acquisition. You acquired her in April. The profit belongs to her. All the profit is for her. Do you get it? The reason why you are doing this, you are coming to share to 2 people. Remember, you and your wife. That is parent and NCI. Do you get it? So what did she have before the acquisition? That's what you are looking for. Yeah, she has the profit. The profit is for the subsidiary. But you came in and maybe you added some technical know-how or something to grow the person from that 220 to the 280. So you have a share. NCI also has a share. It's only an acquisition. It's NCI. That makes sense now.
So, sir, I was confused
Good.
because I was trying to add the NCI as her profit. Have you seen?
No, the NCI is also part of this share. Because whatever you have, you share for NCI as well. This is not only for the parent. Preparing net assets of the subsidiary. So NCI also has a share. Anything that affects the net assets list is shared between the parent and the NCI at the same time.
Good.
That is the secret. All right. Did you get this? There's another way you can go, but that can be a little stressful. Let's prepare the retained earnings account, right?
So, sir, a quick one. So, where you have the period which is beyond one accounting period, maybe 2 years.
The same thing. The same thing. They will give you the profit after tax for the year, even if it's 2 years. The simplest way is to use the retained earnings. Let me explain. So, using something like this, right? So, let's say retained earnings, or you can even do net assets brought forward. It's up to you. So, retained earnings account, or you can say net asset account. Me, I even prefer this one than the one we normally do, where you have acquisition and reporting. So, this one I can say statement of net asset, right? And then I'm going to bring stated capital here. Because stated capital won't change. That's why you can. Then you bring retained earnings here. This one too is not bad. Okay, so I can start with 1st January, right? That's balance brought forward. That's the start of the year when I was not there. So you're looking at the net asset at the start of the year when you were not there. So let's try that approach too, so that you understand what I mean. So you can only pick the retained earnings account though, but let's just see. So balance brought forward. That's 1st January 2024, right? 1st January 2024. So this one, we are saying that, okay, we know this one was still 20,000, right? At the start of the year. But this one, we don't know. Okay. Now, when you have opening retained earnings, what do you come and add for the period? Is it not the profit after tax for the year?
Yes.
Yes. So you come and add the profit after tax for the year. Now, we know that the profit from 1st January to what? 30th March. True or false?
Sure.
Will be how much? Will be 3 months out of what? 80,000. Meboa. No be so.
Yes.
Which is how much? 20,000. By then, were you there? Did you know the lady? By then, were you there? Did you know her?
No.
You didn't know her, right? Good. So at this point, we are saying that there was something plus 20,000, right? You don't know what that something is. That's what you are trying to find. And this is where you came in. The latter part, that is from the 1st April to what? The 31st December, right? You contributed how much? Is it not 9 months of the same 80,000?
From
Is it not 9 months of the same 80,000?
yes, sir.
So you contributed 60,000 of that. But at the end of the day, there were no dividends paid, less dividends, but there were no dividends paid. You are saying that your retained earnings account has now become how much? 280,000 at the end of the year. True or false?
Sure. True.
This is still 20,000. Okay, this one will never change. So it's even this that is important. Okay, so you are saying let's go to primary school. Box plus 60 gives us 280. What is box?
220.
220. That means box was 220,000, right? Good. So something plus 20 gave us 220. What is that something? 200,000. True or false? So literally,
Yeah.
you can get this 200,000 and add the 20,000 to it. Come and get the 220, or take this 280 and minus the 60 to get the 220 that was there before you acquired her. All accepted. So when you prepare the retained earnings account, it's easier. You can just pick the 60,000 as the growth for the year and just share between the parent and the NCI. So this is how we deal with retained earnings when it's not given. If it's 2 years, you build this for 2 years. That's all. Then you pick the profit share between the 2 years. There's one secret people don't know. That's why they stress. Consolidation is very easy. It's just about understanding the concept. I'm taking questions. Before we start looking at cost of investment. Question time. Before
So,
we start,
sir, in summary, where retained earnings is not given at acquisition date, kindly just summarize it in ways for us. Sir.
No, I just gave you the trick. I said when
Yes,
retained earnings.
we did the tricks, but sometimes we want to just jot some of these tricks
Oh,
and then be able to make reference.
Before I started, I gave you the simple one. I said just take the retained earnings at the reporting date. That one they will already give it to you. Then deduct your portion.
Okay, I think
Profit
that's
after.
okay.
I gave you this, didn't I? This is a formula.
Yes, I actually missed that part.
This is it. So just take the one at the closing date and less the portion, your portion of the profit. You are done.
Yes.
That's all. Are we okay?
Yes, sir.
Good. So now let's go to IFRS 3 business combinations, but specifically I want to look at cost of investment or fair value of consideration. So cost of investment. Now, how many cost of investments can you have? You can contribute, you can pay in the form of cash, not so?
Share exchange,
Share exchange,
deferred consideration,
deferred consideration,
contingent consideration.
yeah, dear. Deferred consideration,
Loan note,
contingent
consideration,
consideration, Let's go.
loan note, loan notes, loan notes.
Loan notes, Somebody was also saying, please, I can't hear you well. Oh.
Transfer of a property or land. Transfer.
It could be anything else. Anything else. Okay, it could be table. It can be property. It can be anything. You can give anything in exchange for shares in a company, right? Maybe you have a property, you have an investment. It can be anything. Just know how to deal with it. These are the common ones. And then I will talk about transaction fees, right? Or transaction costs. Maybe if you haven't heard of that one, let me just add it because sometimes you may have transaction costs. Good. So we are going to play around with this a little, and I believe it should be fine. So the ones that give people problem: share exchange, deferred consideration, contingent consideration, no note. Anything else is just straightforward, right? You debit that thing and credit the one that is bringing it in, right? Transaction costs are always expense. What did I say?
You always expense.
Yeah, so sometimes you get consolidation, they tell you, oh, you pay some issue costs or you pay some transaction fees. I getting it. Always expense it. In line with fair value through profit or loss, right? IFRS 9. It goes with the definition of what held for trading instruments because they are held for the short term most of the time. That's the notion behind it. So anytime you see transaction cost in consolidation, always expense them. Are we okay? You always what? Expense transaction costs. Please don't forget this. All right. So now let's take them. Cash. I'll not even talk about cash. Cash, two ways. It can be given straightforward, right? So let's first start with cash consideration. So cash consideration is straightforward, right? It's either given straightforward, where you can just say, okay, maybe they pay cash of 800,000. You are done. Then you just pick it up. Sometimes they'll give you the number of, right, the cash per share. So sometimes they can give you, he paid cash of what? 3 CD, 60 pesos per share. Okay. So you just multiply by the number of shares. So sometimes the number of shares will not be obvious. So the number of shares is going to be what? Hidden in the scenario. Does that make sense? Does that make sense? So how do you get number of shares? You just divide the subsidiary shares by the par value of the shares and then multiply by the 3.6. So if I bought 80,000 shares, then I'll get the cash consideration becomes a 3.6 by the 80,000 shares. There are rare cases where this cash consideration may be influenced by an index, but nobody will go to that level at your level. Your level is like class 1 level, so nobody will go to that level. Okay, let's just that one is more practical, so you just stick with this, right? Okay, so that's how you deal with cash. It will definitely be given. All right, so that's it. Now let's go to share exchange. So I'll give you a formula first. So people usually confuse share exchange. Listen, people don't understand how share exchange works. So let's understand. You are the parent, right? Listen, you are doing swapping from the perspective of you who wants the new phone. People look at it from the other end. See, the parent is the one who is in need of what? The parent needs what? The parent needs what? Shares. The parent needs shares from what?
Subsidiary.
From the sub. So it is like the guy who has gone to Circle and needs iPhone 17. The guy with the iPhone 17, the one who is swapping the phone, wants to know how much you will give in return for the iPhone 17. People confuse share exchange thinking that, oh, people say it's swapping. Yes, it's swapping, but we already know how many shares he acquired, 80% of whatever, right? But how much do you need to give? How much does the parent need to give? That's what we are looking for. So you, the parent, how much should you give in return for the subsidiary share? How many shares should you give? I forgot one. The boss himself. Preference shares. Rare case scenario, but don't worry, we will deal with it. This is rare. Okay, so we'll look at redeemable and irredeemable preference shares if you acquire it as part of consideration. So you need to give. How much do you need to give? So we are looking at how many shares the parent should exchange for the subsidiary shares, because the subsidiary shares is what we are acquiring. The same applies to loan notes. How many loan notes are you giving? So share exchange and loan notes exchange are literally the same. Like we treat them the same, unless it's pure loan notes. Like I promise to pay you loan notes in some time, then it becomes deferred consideration. Literally similar. So how much do you need to give? So actually, share exchange is simply how many shares you, the parent, have to issue, or what type of money or something you need to give your phone plus some money, right? You're going to exchange that and give it to the guy at Circle. Then he'll give you soap and you think it's iPhone 17. Do you understand? So we are saying that, okay, it is just your consideration when it comes to share exchange is simply the parent shares, I get in it, offered, or the parent shares issued times the market price per share of the parent. This is simply the formula, but it can be extended. The parent shares issued, how do you get it? The parent shares issued is giving us what? The subsidiary shares acquired. How many subsidiary shares were acquired? And at what? If you want to convert subsidiary shares acquired to parent shares issued, you have to just take the subsidiary shares that was acquired and multiply by share exchange ratio. So they'll tell you, oh, 3 for 4, right? Then now this gives you the parent shares issued. Then you can now multiply by the market price per share of the parent. So I've given you two things, right? If you don't see parent shares issued, then take how many shares of the subsidiary acquired, multiplied by the share exchange ratio to convert it to the parent shares issued. Then you now multiply by the market price per share of the parent. Did it make sense?
Yes, sir.
So put it down, put it down, put it down. Then let's take some simple illustrations. Please, I'm taking questions. So if you have any question, you can ask before we proceed. Those who have questions, you can start asking why. Is the why that is why we are here? The why. The why is the reason why we are here. I'm looking for a question. I'm looking for a heavy question that we can solve. SK. Papa, I need Papa in there. Yeah. Kamara and we. All right. So let's look at this. I believe you can see my screen.
Yes.
Okay. So on 1st January 2014, Fumba Limited acquired the following non-current investment in the capital market. 3 million of the 4 million equity shares in Kamara Limited by an exchange of 1 share in Fumba Limited for every two shares in Kamara Limited plus 1.25 per acquired Kamara Limited share in cash. Can you see? The market price of each Fumba Limited's share at the date of acquisition was 6, and the market price of Kamara Limited at the date of the acquisition was 3.25. 30% of the 4 million equity shares at the cost of this per share in cash. Okay, so this is with an associate. We are not actually solving it. We just need the cost of investment. So we'll look at cost of investment from different perspectives. So first of all, if I want to get the cost of investment for this one that we just saw, okay, so what do we have? So we can see that if I want cost of investment here, Cash was given, right? Cash. How much did I pay for cash? How much did Fumba pay for cash investment in Camara?
1.25. Oh,
He paid 1.25 per share, right? No, so is it not 1.25 per? Okay.
Yeah.
But how many shares did he acquire? 3 million of the 4 million shares, right? 3,000. Does that make sense? I'm working in thousands of CDs. So that gives us what? In terms of cash? That becomes 3,750. But be careful. You see that you acquired 3 million of the 4 million shares at 1.25. Someone else would have acquired the 1 million shares remaining, which is NCI. Do you get it? So sometimes they'll tell you NCI is fair valued, but you are not going to see NCI in the question. That means you are now going to take this remaining 1,000 shares and now multiply by the market price of the subsidiary shares. It is hidden, but you must know this, right? So that is how you get NCI using the market price per share of the subsidiaries by the number of shares acquired by. If I bought 3,000, then someone else acquired 1,000. Okay, good. Now let's go to share exchange. I gave you a formula. What's the formula? I said, look at the subsidiary shares acquired by what?
Mhm.
The
The
share exchange,
ratio of it.
right? By the market price of the parent shares. That's all. This one, they didn't give you the number of shares the parent should issue. So some people only know this. So when they go and they say the number of shares the parent issued, they get confused because they only know about this. But this is to get the number of shares issued by the parent. So if that is given, there's no need to multiply. If that is given, they will not give you any share exchange ratio. Just keep that in mind. So you just take that and multiply by the market price per share. That's all. Do you get it? So here, how was the exchange? They say he issued what? Second paragraph, a second sentence. Is that by an exchange of 1 share in Fumba for every 2 shares in Camara? Is that not so?
Yes, sir.
So we are saying that, okay, I bought how many shares? 3 million shares. And out of this 3 million, for every 2 that is in this 3 million, I get what? 1 new share. So how many shares would I have issued? Is it not 1,500 new shares?
Yes, sir.
Do you guys get what I'm doing? So we are saying that you have 3,000 in me. So if I take every 2 here, I give 1. If I take every 2 here, I give 1. That means I'll give 1,500 new shares. At what value? At my value. As if I'm issuing new shares to you. And the parent's share price was what? Market price of the parent was what? 6 CDs, right? So you
Yes, sir.
multiply this by 6 CDs, and that is it. Is it 9,000?
Yes, sir.
Good. So that is it. But remember, what is a double entry? We are adding this, we are increasing the cost of investment. That means we are adding this to the cost of investment. And that is what we have here. Okay. Now, the credit will also go and increase our share capital because it's like we have issued new shares. It's not like it's like it is, we have issued new shares,
additional share.
right, for the same 9,000. So these additional shares, when you get to share capital, so share capital is the parent only, right? So the parent
Yes.
only,
Parent share.
I'm going to take the parent only. If I'm preparing the account, the parent only share capital was 10,000, right? I'm now going to add
10,000.
that 9,000 to it in my consolidated financial statement. So I always open bracket and put this there. Then after I read, then I come and add this up. Does that make sense?
Yes, sir.
Good. So that
Yes,
was
sir.
share. I hope you understood it very well.
Anytime there's share
Yes,
for
sir.
share exchange, it increases the parent share.
Yes, it increases the parent shares because it's the parent issuing shares in exchange for its investment. So it has nothing to do with the subsidiary.
Okay.
The subsidiary shares has already been acquired. So that's why I said, wow, exchange phone was circle. No. It is your perspective you are looking at it from, not because you are preparing for the owners of the parent. Don't think from the owners of the subsidiary. You are the owners of the subsidiary anyway. Don't look at it from the point of the subsidiary. That's what I mean. Are we
Hello,
okay?
sir.
Yes, boss.
Yes, sir.
Yeah, quick one. In this case, if there should be a share premium to the statement of financial position,
If
check
there's
the
share
share
premium,
value.
share premium is still stated capital. Just that in Ghana, we don't do share premium. We have share deals though. But when there's share premium, okay, all you do is that the cost of investment will still take the 9,000. Let me explain to you. You see, these shares are 6 CD. Share capital in international terms can only take shares at 1 CD. Are you following? I said can only take shares at what?
1
1
city.
city.
1 CD. Anything beyond 1 CD goes into what?
The share premium.
The share
The
premium.
balance.
So that means here you are going to debit share capital with 1,005 because 1,005 times 1, right? Which is going to be 1,005. Then you are going to credit share premium with what? The 1,005 by what? The 5 CDs remaining,
Right.
right? And that gives us
Okay.
what? 7,500, right? So this has
Thank you.
to be. So when you get to the financial statement, you are going to say stated capital 10,000 plus 1,005, share premium 5,000 plus 7,5. Then you are done. So anytime you want to do share premium, just play the stated capital. Anything at 1 CD goes to share capital. Anything beyond that 1 CD goes to share premium. Are we okay with share exchange?
Yes, sir.
Yeah.
I didn't person connected to hotspot.
Are we okay?
Hello, hello, sir.
Yes.
Yes,
Please.
please.
The treatment of the cash,
Yeah.
the entries,
You said the treatment of the cash?
the entries. You've not done the
Oh, no,
entry.
no. See, please, you are accounting students. You must understand that every question in the world that they give you in exam, the cash transactions are always passed before they give it to you because cash involves a lot. So, have you ever passed cash entry in any question before? You haven't been paying attention. Every time they pass the cash entries for you, you never pass cash entry because that's not the focus. Cash is easy to spot because they are receipt and other stuff. So nobody ever worries about passing cash entries. Do you understand? This is actually a credit to cash and a debit to cost of investment. The credit to cash has already been passed. Makes sense.
Yes, sir.
In accounting, we never pass cash transactions unless you are doing financial accounting. You are doing financial reporting. So they do the cash side for you. Erica, are you okay now?
Yes.
All right. So nobody will ever ask you to pass a cash transaction unless it was completely ignored, which even that they will tell you the cash side has been passed. So there are some rules to every question, and this has been the norm. Okay, so that was it for share exchange, and then what do we even call it?
The cash.
Now, if there's a loan note exchange, let me go there, right? If there's a loan note exchange, it's the same thing. It's the same thing you are going to do. But now it wouldn't be shares. They are going to tell you that the parent exchange what? Loan note. Okay. They're going to tell you that the parent will exchange loan note for the subsidiary shares, right? And you see on the parent accounts that they are loaned, like in the liabilities, that they are loan notes there. Just like you see this 7% loan note. You see it's 5,000 here. Can you see?
Yes.
So they are going to tell you that this guy is going to issue what? 100 CD loan notes. I getting it? For every 5 of the subsidiary shares. Do you understand?
Sure.
So if I'm going to issue 100 CD loan notes for every 5 of the subsidiary shares, all you are going to do is take the 100 out of the 5 and just multiply by the number of shares acquired. And we know that the number of shares acquired was 3,000. True or false?
Yes.
So what does it become? So we divide this by the 5 and multiply by the 100. And that gives us what? That means how many new loan notes will the parent offer? How much loan notes will the parent offer?
60,000.
How much?
60,000.
60,000. But how many loan notes did the parent offer? Each loan note is in 100 CDs, right? By
Yes.
this divided by 5, you're saying 3,000 divided by 5. 600. So that means the parent is going to issue 600 new loan notes at 100 CDs each. And that gives us 60,000. So when I get to 7% loan note, I'm going to say what? Open bracket and bring the 5,000 plus this 60,000 that I have issued. That is all. This is how we deal with loan notes. Any question? You see, it's just like the normal share exchange.
So kindly come again with that one.
No, they will give you a ratio, just like the one we saw where they said 2/5, right? 2 new shares for every 5 shares held in the subsidiary. Yeah, they'll tell you 100 CDs loan note for every what? For every 5 shares in what? In Camara. Does it make sense? So all you have to do is just what? Take the number, take the what? The loan note exchange ratio, and that's the exchange ratio, 100 for every 5 shares. Do you understand? Does it make sense now? So you are going to take 100 CDs for every 5 shares held in the subsidiary times the number of shares. All right. So once you do that, you come and get the amount. Then that becomes the cost of investment. So here you are going to debit cost of investment, which is this 60,000, and you are going to credit what? Loan notes in the parents' books. That's all. These are you all okay now?
Okay.
The person who said I should go over again, are you okay now?
Yes, sir. Thank
Okay, good. Now let's go to deferred consideration. Now this is where people usually, I believe everybody here knows how to discount.
Yes, sir.
Yes, sir.
Principle in accounting, straight from the conceptual framework. Okay, when it comes to measurement, we can measure also using fair value in terms of present value, right? And one thing in accounting is anything that is in the future, you have to what? Bring it to the present, because we are accounting in the present. Then we grow it with interest. This principle comes from IAS 37, right? Dismantling cost and contingent cost, decommissioning cost, all of them follow the same idea, right? So anytime something is in the future, you bring it to present value by what? Discounting it, right? So you always have an initial measurement, and the initial measurement is that this is a liability, right? But then it affects a particular item, cost of investment, which is an asset. So always the rule is that when it comes to dismantling or any cost in the future, you're going to have to debit some asset or expense, all right? And you are going to what? Have to credit a liability. That's the very first time you do it. So this can also apply to what? IAS 37. So in case they tell you that the asset has a dismantling cost, so you are going to dismantle it to get the fair value as at today. Okay, then you are going to create a liability. But then if this one was 100, but you discounted it from 500, then you have to grow the 100 till it becomes the 500. Do you get the idea? That is where you unwind the discount. Who has heard discount unwound before?
Yes, so why it?
Yes, we've heard it.
And what does it mean? You don't
That's the
understand it.
interest.
you. Is the interest in future
The
value?
interest component of future value.
No, I mean the word discount unwound. What does it mean? Yes, it's the interest. But let me explain it in simple terms for you. Now, if you are discounting, you are moving from the present value to what? The future to what?
Future value to present value.
Yes. So if you are discounting, you are moving from present to what? If you are discounting, you are moving from future to present. Dynamic. Yes, you are moving from future to present, right?
Yeah.
And when you are compounding, you are moving from what? Present to what?
Present to future.
Okay. Now, if I turn a discount, if I unwind the discount, what happens? If I unwind the discount, that means I'm what?
Mean the present to future.
No, if I unwind the discount, that means I'm now what? You don't get my question. It's only between compounding and discounting. This is from future to present. So if I turn it the other way, then I'm moving from present to future. Then I'm what?
Discounting.
Compounding.
No, you are compounding. I said
Compounding.
you are
Yeah.
discounting and you unwind it. You turn it the other way around. Then you are what?
Discounting.
No,
Compounding.
are discounting now. If you turn discounting the other way, it becomes what?
Compounding.
Compounding, that is all. So discount unwound means you are unwinding the discount. You are changing it from discounting to compounding. That's all. So discount unwound is not just interest. You are compounding. That's what it means. So in finance, once you discount, you must compound it to become what it was. That's what discount unwound means. Compound. And what do you compound with? You grow it with interest. Is it clear now? So if you unwind a discount, it becomes a compound. If you unwind a compound, it becomes a discount. Do you get the notion behind it now?
Yes, sir.
Are you sure you all get it? Are you sure you all get it?
Yes,
No,
sir.
sir, I'm not clear.
Look, if I have 100, okay, in present value, that means it was, let's say it was a figure of what? 200 in the next what? 3 years, okay? Now, this was the future value. This is the present value. We brought this from the future to the present. We call it what? Discount, right? Good. Discounting. Now, if I'm doing accounting, this 100 is today. Let's say the interest is 50. So we are going to compound it till it becomes a 200 again to be reflected in our books. That's what unwinding a discount means. It means now you are going to add interest to grow it, which is compounding. Does it make sense now? So if today I've recorded 100, okay, year one, interest of 50 will come and add it, meaning I've done principal. It means I've done principal 1 plus what? R for the first time, right? I've increased. Is this not compounding?
That's compounding.
Which brought this? This is the principal plus interest together. Now, in the next year, this will increase again by another what? This is now 150. It will increase by another what? 50 again. Now, what has happened? Has it not grown back to become the 200? So what did you do?
Yes, sir.
You compounded. Have you understood now? Yeah, so unwinding a discount is simply compounding. That's what I've been saying all along. Is it clearer now?
Yes, sir.
Good. So those who like double entry. So anytime there's deferred consideration, initial measurement, or somebody say initial recognition. So initial measurement, what do you do? First, and even for deferred consideration, you still have to check. One, is there a present obligation? Will it result in an outflow of economic benefits? Can we reliably estimate it? If it meets, definitely. So if it's in a question, that means it meets the criteria under IAS 37. But usually because it's straightforward, we don't even talk about it. But that you still have to check those rules. Sometimes some deferred considerations do not hold. And that's a rare case for ICA exams anyway. So let's see. So initial measurement, I told you debit what? An asset, which is actually a cost of investment. Okay. And then we are going to credit what? The initial liability for the deferred consideration. So we are going to create what? The deferred consideration, which is actually a liability, right? So that is it. Then subsequently, that means the next time we are going to work on this again, all we are going to do is now increase it with what? Finance cost. So we are going to debit what? Finance cost. Okay? Because we are going to increase it. And this finance cost is what you guys call the discount unwound. But I like to use finance cost because it relates, right? Then we credit what to increase. So every year we'll be increasing the liability. So you are going to increase this liability year on year with this, right? The deferred consideration. So this is how you actually work with deferred consideration. So I'm going to take an illustration for you to understand, and we are going to really account for it. So let's just say that ABC Limited promises to pay, right? Promises to pay. Anyway, don't mind me, it's from my head, okay? Promises to pay, let's say 500,000 in the next 4 years, right? Promises to pay. Please write it down now. Promises to pay 500,000 in the next 4 years, right? So pre-market interest rates at 10%, right? So this is what we have. Just this. Okay, so if we are to record this deferred consideration, all right, what are we going to do? The first step is to do the initial measurement. Okay, so let's just say that we are standing in, so ABC acquired XYZ 3 years ago. 3 years ago, all right? Yes. So let's just add that. So our initial measurement, which is 3 years ago, the date of acquisition, we said you must debit your cost of investment and credit what? The liability. True or false?
Yes, sir.
So this is what you go and add to cost of investment. That's the present value, right? So our cost of investment, I'm going to discount, and we all know how to discount, right? So I'm just going to take this 500,000 and multiply by what? 1.1 raised to the power negative what? -4, right?
Yes.
No, be so. So that is it. Or simply take 500,000 over 1.1 raised to the power 4. It's the same thing. What does this mean? It means that if I have 500,000 times 1 over 1.1 raised to the power 4, okay, which now became this, because 1 over A is the same as A inverse. So that is why we have this. Okay. I believe everybody's fine.
Yes, sir.
All right. So in that case, once we discount to present value, what do we have? $341,507. So you have 341,507, which goes into your cost of investment, right? But then we have to what? Increase our what?
Liability.
Our liability, which is the initial measurement for the deferred what? Consideration, right? Okay, good. So the same 341, right? 507, right? Okay, 507. 341,507. Good. So we are done with that. Now, subsequent measurement is where you have to do the finance cost, right? But I prefer you can do this with what? An amortization schedule. Whose background is disturbing? If you are using 2 devices, just lower the volume on one so that there won't be feedback. So for subsequent measurement, you can prepare an amortization schedule for it. So subsequent measurement, you can prepare amortization schedule for it. So you can decide to go vertical or horizontal, it doesn't really matter. So year 1, year 2, year 3, and year 4, right? So if I take my balance brought forward, just like you do in leasing, financial instrument, I get in the same. Balance brought forward becomes what? The 341,507, right? Okay, then we add interest. So I'm going to add finance cost or interest, which is what? 10%. True or false? So I add interest, which becomes 34,150. Oh? No, so. No, be so.
Yes. Yes, yes, sir.
Actually, this one we less cash, right? But there's no cash here. So I'm just following the same approach. And then this becomes our balance what? Carried forward to the next year. So that gives us what? And literally what you are doing here is that you took principal, You added interest. So you actually get what? Principal 1 plus R. That's what you're actually doing. So if I just multiply this figure by 1.1, I'm still going to get the same figure here, which is 375,657, right? 375,657. Now this comes to the next year, right? The same 375,657. Interest at 10%, 37,566, right? Then you get 413,223. 413,223. We bring our 413,223 forward. Then we have 41,322. You end up with what? 4545. 454545. We bring our 454545. Then you have 45. 40. Is it 45? 45? Yes, 45. 4, 5, 4. Oh, 45, 455, yeah. Oh, why is this in even? 45, 455, right? Do you all agree?
Yes. 4, 5, 4,
So
5,
at the
5.
end of the day, you see that the figure that we recorded initially has now grown to become what? 500,000 after 4 years. True or false?
It's true.
Initially was 500,000. Then we brought it to the present, and then we have compounded it to now become 500,000 again by just adding the effect of the interest each year, right? So it's interest that we're actually adding to this 341 every year to make it become this 500,000. And most questions will tell you that you are standing. Which year are we standing? Year what? Year what?
Year 3.
Year 3, and they will tell you that the deferred consideration has not been recorded. So it means that they've only recorded this one, the initial one, but they have never added the interest from year 1, year 2, and year 3 yet. Do you understand? So if they haven't added the interest for these 3 years, all you have to do is add this plus this plus this. Are you getting it? And just go and deduct from the retained earnings. But if it's in the P&L, you're only going to deduct the one for this current year as your interest expense. So if they've only recorded 341,507 in your balance sheet, you are now going to record 454,545 because you're going to add interest for the 3 years to the initial liability. Because in our deferred consideration account, how much are we having now? They have only recorded 341,507, right? So you are now going to add 34,150, add 37,566, and finally go and add 41 what? 322. Right, to get the final liability of this 454,545. Does it make sense? Because that was never recorded since the 3 years you acquired the person. Does it make sense?
Yes, sir.
Good. So if you are doing P&L, remember P&L is just for a year, so you record only the current finance cost. So this is how we do deferred consideration. Did you get it? But you know, I like to make things simpler. Now that you've gotten the concept, remember all this while what you were doing was that you were taking this and just multiplying by 1.1. So if I take this and I multiply by 1.1 to the power 1, I'll get this. If I multiply by 1.1 to the power 2, I'll get this. If I multiply by 1.1 to the power 3, I'll get this. Try and see. You are just compounding. So, in simple terms, if I want the deferred consideration for any year that I'm standing, is simply just taking the present value multiplied by 1 plus R raised to the power of the consolidation year, the year in which I'm standing. That's all. Did you get it? So there are no stress with this table, but I wanted you to get the understanding first. So if I want my deferred consideration, it is what? The present value 1 plus R raised to the power of the consolidation what year? The year of consolidation I'm standing. If you like, let's try it and see. So I'm just going to say, okay, if I want my deferred consideration is 341,507 multiplied by 1.1 raised to the power, I'm standing in year 3, right? So raised to the power year 3. Multiply and see. Don't you get 454? 545? Oh, do it and see whether you don't get the same. You see how I didn't build a table, but I came to get the same 454545. You see? Straightforward, right? Straightforward, right?
Yes, sir, you are getting the same thing.
Yes, of course you should. So what about the finance cost not yet recorded for the 3 years? The finance cost that has never been recorded. Add it up and let's see. 34,150 plus 37,566 plus 41,322. That's 113,038, right? So that's the interest not recorded. So we'll come and add the 113,038 to the original finance cost, the original deferred consideration, to get the total 454,545, right? Okay. But then how do you get the discount unwound or the interest not recorded? So the finance cost not recorded, how do you get it? Instead of doing this long table, what if it was 30 years? Would you go from 1 to year 30? So all you have to do is just take PV, are you getting it? 1 plus R raised to the power the consolidation year you are standing, and just less the PV from it. That's all. So in this case, if I want to get the discount unwound, are you getting it? All I will do is take my what? The 341,507 multiply by 1.1 raised to the power 3 minus the 341,507. That's all. And you arrive at 113,038, which is the total finance cost not recorded. If I want finance cost for only year 3, I can simply say that, okay, this one becomes the PV 1 plus R to the consolidation year I'm standing minus the previous year, which is PV 1 plus R raised to the power the consolidation year minus 1. So that means the previous year, right? So let's say I want finance cost for year 2, the year 3 I'm standing. So I can say this is what our, why is this thing behaving like that? The PC is tired. You get our 341,507 1.1 raised to the power 3 minus our 341,507 minus 1.1 raised to the power what? 2. And you are going to get your finance cost to be the same 41,322. 41,322. So you see, this is only for 1 year. Year 3 finance costs, which goes to your P&L. This is what goes to your consolidated retained earnings to go and reduce the total retained earnings. This is what goes as deferred consideration. So that's all about deferred consideration. I hope I didn't complicate it for you. I hope I didn't complicate it for you. Question time.
It's okay. It's okay, but I hope when we start solving it will be more clearer.
Hello, sir. Hello, sir.
Yeah, hello. Yeah, hello. Somebody was saying
Yeah, hello.
hello.
So, yeah, the finance cost that will be the one in some books, you realize that for them to get the finance cost for the P&L for that year, it should be the rate multiplied by the answer that you got. It's the same as what you got. But I think
That's the same
what
thing.
you got is okay.
So if you want to get the finance cost, you have already done it here. You see, somebody said if we start solving questions, it to be clearer. This is a question. You see, get the concept. A concept, no, T. every year you are adding 10% on what was already there. So if I want year 3 interest, is it not this 413223 multiplied by 10%? That is it. It is already done in this
Yes,
table, but I'm giving you a shortcut. That is all.
Uh,
It
okay.
here. There's
Okay.
nothing like when we start solving
Oh, okay.
the question. So which one is where we start? Get it here. That when we start solving questions, it will be clearer. Yeah, no, mister. This is the concept. Have you gotten this? If you haven't gotten it, this is it again, right? You take the initial one each year. If you know that financial management thing will confuse you, just create your table and say, okay, year 1, I add interest. Year 2, I add interest. Year 3, I add interest. Year 4, I add interest. Okay, which year am I standing? I'm standing in year 3. If I'm doing P&L, then I only take this finance cost to the P&L, right? If I'm doing balance sheet, the consolidated retained earnings, they haven't recorded anything from scratch, only this one. So if they've only recorded this one, then I have to add all this finance cost. Finance cost is an expense. So you are going to reduce it from your what? Your consolidated retained earnings. True or false? That's all. But on your balance sheet, the liability is the sum total of the initial one plus all this which has not been recorded. And this is the liability you got. So you just pick this 454,545 because you're in the 3rd year of consolidation. And you just go and treat it as a liability. That is all. Are we okay with deferred consideration?
Yes, sir.
Yes,
Yes, sir.
the concept well understood.
You said?
Said the concept well understood. In fact, I actually have a very serious problem with this, but I
Yes,
think
I
I'm
know
now where.
people have a lot of problems with reporting because of the fundamentals.
Okay.
Yeah. But I believe we are all getting there. Okay, so we are now coming to talk about, hey, time is gone. People must go to work. Okay, let's just talk about contingent consideration and let's close. The preference shares, I'll just give you the concept. It's very easy. Now, for contingent consideration, if it's a liability, you just treat it like, what is contingent consideration? It's a consideration that depends on something. Okay, so I'll tell you that I'm going to pay you 500,000 in the next 3 years. If your sales hits maybe 10% of something, 10% of your maybe net assets or something. Do you get it? So there's a target. So if you meet it, you're actually supposed to be given. But here lies the case. Because we have already decided it at the acquisition date, whether I meet it or I don't meet it, you still have to recognize it. Does it make sense? Because we decided it at acquisition. We can't tell whether it will be made or not made. So you need to still recognize it. Do you get it? Because there's still a present obligation. So this contingent consideration at FR level, they don't really go into detail. They just give you just like the way deferred consideration is. But in actual sense, contingent consideration can be a liability. It can be a liability or it can actually be what? Equity. Do you understand? So we are saying that, okay, when it's a liability, we actually revalue to fair value. When it's equity, no revaluation. What do I mean? So they will tell you that, oh, at the date we entered into the obligation, right? The initial amount was, let's say, 20,000, right? But in 3 years' time, you remember I promised to pay you an amount. So if in the 3 years' time the value is now 40,000, it means 40,000 is now what you are going to recognize, not the 20 again. That's how liabilities work for contingent consideration. But if it is equity and I issued you 20,000 shares, but on the D-Day, if it has become 40,000, we are not going to record 40,000. We will still record the same 20,000 that we initially recognized. This is all about contingent consideration. If it's in the future, discount it to present value. If the value changed at the date of payment and it's a liability, change it. That's all. Yeah. Okay, so that was the end of our class today. I hope you learned something.
Very well, sir.
Good.
Very well, sir. Thank you.
So may the Lord be with you. When we meet again, we will now put all the concepts together and then we'll solve this question and another one. All right. Have a blessed day.
Thank you very much.
But I hope gradually reporting is getting simpler and simpler for you.
Yes, sir.
By God's grace, yes, sir.
Good. All right. Nice day.